Hello everyone and welcome to our latest webinar in the series of educational webinars that Hantec Markets is putting on for anyone who chooses to attend. And my name is Richard Perry. I'm the market analyst at Hantec Markets, and I will be doing these or presenting these webinars, and this one is on understanding single period charting patterns. It's for basically giving a guidance as to how to trade using chart analysis, and this is the first one of two webinars that I'm going to be doing on this sort of topic. This first one is on single period patterns, specifically using bar charts and candlestick charts as the medium there. Next week I'm going to be talking about pattern analysis as well, so I'll be covering both topics as we go on. But first of all, this is the disclaimer that I've got to show you, because I'm going to be doing live market analysis, and that means that you need to be hopefully reading and understanding this disclaimer of ours. And what I'm going to do is I'm going to put it up back at the end of the seminar as well, to give you another look at it, just in case you've missed it this time. Once again, a little bit of introduction to myself. Market analyst for 13 years, just working in FX and equity markets, using technicals and fundamentals to guide my views. I've got an STA diploma, Society of Technical Analysts diploma, and also an investment management diploma as well. So that's just quickly on me. Okay, so what we're going to be covering today is, as I said, chart analysis using a series of charts. We're going to be looking at line charts, bar charts, and candlestick charts. I haven't really got the time to cover other forms of charting analysis, such as point and figure or market profile, but they are two other versions of charting analysis you can look at if you choose to do so. Through this analysis, I'm going to be looking at single period bars, and the information you can get from them. They're going to look at candlestick patterns, and throughout I'm sort of going to be doing probably just interspersed with the theory. I'm going to be looking at the live market analysis anyway, and towards the end I'll probably be looking at more of a market overview of more technical indicators, and as the weeks go on, you'll be able to get a gauge of exactly what all these indicators come together mean, because as we talk about them more and more, you'll hopefully be able to understand them. But throughout this process also, please feel free to ask me any questions that you might have. There's absolutely no problem with me just interrupting myself and answering these questions, but if I do miss anyone out, then I will endeavour to get back to you, and if I have missed anyone out and you feel that there is more information that you want to get on a topic, please just drop us an email, and I'll give you the details towards the end as to how best to do that. Okay, so we're going to start off with line charts. Predominantly is the first topic we're going to look at. It's a very short topic, in my opinion. A line chart doesn't give you anything at all, really, and it's basically it is the most basic form of chart you can get, because it just interlinks two prices from different periods across the chart. It gives you no more information than that. The vast majority of line charts use closing prices, so you'd be looking at a weekly close, a daily close, hourly close, 5-minute close, etc., etc. So it just gives you a gauge of how the prices are trending. It doesn't give you much more than that, and for that reason I don't tend to look at line charts very often, if often at all. It's only really when you look at really single data points that I think line charts are useful. You can argue that long-term equity analysis you can use line charts on, and it is possible to do that because you get so much more of a longer term view, and knowing the intraday data is not so important. For example, on a line chart, on an equity chart over the course of maybe 10 years, but certainly the analysis that we're doing here is much better to use bar charts and candlestick charts, and for that reason, you've got the bar chart. I've shown you the diagram here where you've got a lot more data on a bar chart than you do a line chart. You have although you can have different bars, I've shown here the open, high, low, close bar. You can also have just a purely high-low bar, and also a high, low, and close bar as well. But the ones that predominantly give you the most information is the open, high, low, close bar, and that is because it shows you the psychology of how the price is moving through the period. Again, whether it be the weekly, the daily, hourly chart, whatever, it shows you how the price is moving. And on this example here, you see the open price not far off the low of the bar. You then had at some stage in the day a dip, probably early on, to form a low, and then a rally up towards a high, and then a close back towards the high of the bar. So that would suggest you've got a fairly positive trading day there. Candlesticks as well, similar information, in fact exactly the same information, it's just more visually clear exactly what who's winning or losing the day in terms of bulls and bears. In terms of these two candlesticks we've got here, you've got on the bearish candlestick, you've got the open, and it closes below the open to form the body of the candle. In this instance, a black body, and you've then got the two tails or shadows, whichever way you choose to call them, at the high and the low. And on a bullish candle, you've got the close above the open and a white candlestick here. Okay. As I said, you get a lot more information out of candlesticks because they are more visually clear. You instantly can see who's winning on just a quick glance, really, and for that reason, a lot of people do like to use candlesticks. And also, you can a lot of the trading charting packages you get, you can set them up to configure them to your specification on different colors. I know MT4 you can do that certainly within the charting package, so that's a very good basis for you to personalize your charts, so that's good. Okay, so that's a bit of theory. In terms of how we're reading, going back to the bars now, how we read the bars across the day. As I said to you, you basically see where the close is in relation to the open, and also the distance we're closing away from the high and the low. So, say for example, you've closed towards the high of the day, having opened towards the low. That means a strong bullish day. I'll quickly whiz through these because they're fairly self-explanatory, to be honest. If you close just towards the middle of the day, having opened at the low, it just shows that that initial burst of bullishness has been lost throughout the day, but certainly still the bulls are still in control to a certain extent, but they've lacked a bit of conviction in the move. Buyers losing control is where you've had that move to the upside, but then you've completely retraced it, so that the sellers have regained control towards the end of the day. So that would suggest selling pressure is beginning to increase. You've got sellers in control. Or these next three are to do with the sells, the bears being starting the day in control, and what you've got here is a close towards the low, open towards the high, close towards the low. That suggests strong selling pressure. Close towards the middle of the day suggests again lacking conviction in the selling, and a close back towards the high of the day suggests a loss of control to the downside. So a lot of pretty much the opposite to what we spoke about earlier. And so if you open towards the middle of the day, you've got a bit of an indecision on the day. If you close back towards the middle of the day, that's no real control. When you start to move again to the upside, it suggests buyers are gaining control, and moving down to the downside, sellers are gaining control. So that's the general bars, and these are. I'm going to move on to inside and outside days. Inside day is basically an uncertainty day where you've had a strong move on the previous period. I've written days here, but it could be weeks, hours, whatever trading periods you're using. Okay, so an inside period or day is where you the high of the day is below the high of the previous, and the low is above the low. So basically, the whole of the trading day is inside the previous day, which suggests an uncertainty about the recent move. Now, even more, I think, interesting than that is the outside day, whereby you have the whole of the trading day outside the previous day or previous session period, whatever you choose to be trading. So you've got the high above the high, the low below the low, and depending on where you close will show whether the bulls or the bears are in control of that. So it certainly can denote either strength of the underlying trend or potential sign of a reversal. So very key trading period that is, and I do put a lot of weighting behind outside days in my analysis. Okay, so quickly on to candlestick patterns. On candlesticks, you've got so as I said earlier, you've got closing above the open suggests a bullish candlestick. So you've got just a very slightly bullish candlestick at the right there on the left, and then you're strongly bullish. Closing below the low, so closing below the open, you've got a slightly bearish candle and then a big bearish candle. Now, your Marubozu candles. Now, a lot of candlesticks are given Japanese names, and that is because the Japanese invented candlestick analysis. They're very popular in Japan, and you do tend to find that it does work pretty well on not only the Nikkei but also dollar yen as well. So it's very something to bear in mind. And because it was invented by the Japanese, you do tend to find that they have given a lot of Japanese names. There are simply hundreds of candlestick patterns across 1 day, 2 days, 3 day patterns, and far too many for me to obviously name now. But I've got 8 or was it 9 different candlestick patterns for you to watch out for. Pretty basic candlestick patterns, but they are some of the more important ones. And I think one of the main things to remember about candlestick patterns is it's often about where how the body is in relation to the tails as to how bullish or bearish the candlestick ends up being. Now, what you've got here is the second one I'm looking at here is Marubozu, which is basically where the low on a bullish Marubozu or a white Marubozu, you have the low of the day at the open, and you trade higher all throughout the day to close at the high, and that is a strong bullish candle. The opposite to that is a black Marubozu or bearish Marubozu, which is to open at the high and trade at low all throughout the session to close at the low. 2 very strong candlesticks there, and you will often see that comes as sometimes as a part of a breakout, but often you'll see that as part of a series of strong candlesticks, and it's very interesting. And when you see a Marubozu, you'll tend to be rather strongly either bullish or bearish. Pretty much the opposite of that is a dojis. Basically, where you open and close at the same point of the day denotes significant uncertainty. No real gain either way, just denotes indecision within the previous trend, and certainly when there's a small body as well, that would suggest that the trading trend pattern is not very strong, or beginning to possibly come towards some sort of a reversal. Okay, so then you've got Dragonfly Doji, which is a again, it'll often depend on where these patterns are found, because you'll see these Dragonfly and Gravestone Doji. In fact, they are pretty similar in terms of patterns to the subsequent hammers and shooting stars. So I'll talk about them in a minute. But certainly, the Dragonfly Doji is on its own a bullish pattern, and your Gravestone Doji is on its own a very bearish pattern, where you open and close on the Dragonfly, open and close at the high, trade down, and then retrace all of that loss to close back at the high again. Gravestone Doji, you've had an attempted move to the upside by the bulls, completely retraced to close back at the low again. Now, ultimately, that is a very similar charting pattern to your hammers and your shooting stars. The hammer tends to, if you look at ultimately, a hammer is ultimately a Dragonfly Doji, but with more of a move to the upside towards the end of the day. So you actually close above the open. You can get hammer candlestick patterns whereby you are showing a close below the open, or a very slightly black, or depending on your candlestick color configuration, red candle. But that then means that you need to start looking at the next period of candle to show confirmation. I said earlier, it's best to to wait for confirmation in many of these patterns before we start to trade in a specific direction. Okay, so shooting star is the opposite of a hammer candlestick. Shooting stars come at the end of an uptrend, and you have a rejection of the price movement to close below the open, rejection of that upside move, and it then starts a new downtrend. Just as an aside, these two patterns here, inverted hammer and hanging man, you don't tend to see them too often. And definitely you would need to be watching for subsequent subsequent candlesticks after those two patterns to really go for a specific trading direction. Okay, so I'm going to show you how these are shown in the market. So here is the FTSE. I'm going to start off with FTSE 100. You'll see here that you have got, I'll zoom in slightly to give you more of a view, a very strong candlestick pattern, and you've got a nicely strong Marabuzu. It's very slight bit of a tail to the upside, but certainly you opened at the low and you closed very close to the high, and that was is a rejection of that move to the downside, and that started that big bold uptrend that FTSE had been in then for subsequently a few months. Okay, so moving on to another Marabuzu in April 2013, where again was really the start of the new trend. As I said when I was telling you about the theory, that you do quite often see when you get a breakout in a specific direction, you'll get that pattern happening. Okay, I've just noticed another pattern here. You've got a hammer candlestick pattern where you've got the rejection of that move to the downside, closed towards the high of the upside, and then you started. It didn't last very long, but it certainly did initially see some upside. Okay, so 2000, here we go. Here's a shooting star. In fact, I did say that there are 2- and 3-day patterns as well, and this is on the FTSE. This actually formed what is known as an evening star pattern. You had the shooting star, which came after this strong bullish candle. You have an evening star where you have a rejection to the upside, and then you had this strong move to the downside. So that just suggests that the move has been rejected to the upside, and that ultimately then began that 6-week correction on FTSE. You've got a few more candlesticks in here, but you've got a Marubozu there. You've got an outside day here on this pattern here, which encompassed entirely that previous trading day. Subsequently, the FTSE moved to the downside, and then you saw that completely and utterly turned around with this bullish key one-day reversal, where you see a new low, close towards the high, entire trading day outside the previous day, and then bang, you're away again to the upside. One of my favourite patterns in I've got this on candlesticks, but if I just showed you what that would look like on a bar, you can see here you've got that open and then the close at the high. So I'll keep it on candlesticks because it makes it much easier to see, but there are also bar chart analysis that I'm going to be talking about. But to be honest, when you've got it on candlesticks, you can see the move anyway, and it's much easier to spot. So yeah, you had that key one day reversal. You had that Marubozu at the start of the trend, which continues up, up, up. Lots of big green candles. There's another one you could say there. So yeah, a very strong trading period throughout December 2013 there. Then you saw the top on FTSE, again, similar sort of pattern here. You had a shooting star. In fact, I sort of would have called that a double shooting star, because you had two attempts to break out. Both of them failed. Both of them closed below towards the low of the day. And then subsequently this trading candlestick up subsequently then confirmed it, and you had three big red candles in a row. Very strong move to the downside. What else we got on FTSE? You had a hammer candlestick, you can argue there, which saw renewed upside. You then got another bearish key one-day reversal at the high in May. Very interesting. That was once again a strong candle or bar was seen at the high. Then not a huge amount throughout this trading period, and then you did see a dragonfly doji, but that dragonfly doji, as I said earlier, we need to be sort of waiting for the next subsequent candle to really see how the psychology is, because that move was then rejected to the downside, and that ultimately, you could argue, then turned into, on FTSE, that then turned into a hanging man. So it's I think one of the things I will be stressing continually throughout this is that you need to be waiting for confirmation a lot of the time, because some of these candlesticks that you do see on a day-to-day basis or a period-to-period basis do not turn out to be confirmed by the subsequent trading period. So you need to be looking out for that. Okay, so as FTSE on a daily, does it work on a weekly? Yes, it does. You had, this is throughout 2011, the first 6 months of 2011, key 1 week reversals all over the place. In January, you then had one in February, and then you then had one in May. So key 1 week reversals where you had FTSE hitting a new high, although it's slightly below that high there. It certainly was above the high there, to close below the low of the previous week. And that happened 1, 2, 3 times. Each time it didn't really ever it started to push to the downside. Certainly this initial one was, you could argue, a bit slightly rejected, but subsequently that second one there in February would have got you pretty bearish, I think, or certainly concerned as to how strong the move was to the upside. And then the one in May was your third one, again at that resistance that we had in place. I will put my crosshair there. That resistance pretty much bang on hit and subsequently saw a key 1 week reversal in May, and you saw then another, what was it, 8 weeks worth of downside. You had a sharp move to the upside, but then you saw what I would suggest would probably be a shooting star to a certain extent, again confirmed by the subsequent candle, which was bearish. So then you're starting to get concerned that there's going to be a rejection of that move, and lo and behold, you've got a sharp move to the downside. So very interesting there on the weekly. On the hourly chart, where are we looking at? Well, this is just in the last few days. There you've got a key 1 hour reversal on the 17th of June, which then subsequently saw FTSE completely turn around. So had been in that downside shift, and then we saw that it bounces back up again. So I just got a question. So just get to see that. Sorry, 1 second. I thought you were going to be talking about currencies. Yes, I will be talking about currencies, no worry. I will be looking at currencies in the next few minutes. I'm just going to be looking at FTSE. If you care to wait, I've got FTSE lined up, then S&P 500, gold, and then euro, dollar, sterling, dollar, yen, and finally on the DAX. So just a couple more charts, and then we'll be looking at currencies. And then what I'll be doing towards the end is basically I'll be doing a very quick analysis of all the major currencies as well. So there's no worries, you will get to talk about currencies. Okay, so that's FTSE. On an hourly chart, you've got that key 1 hour reversal all the way up, and that was then stopped by another bearish key 1 hour reversal. So you had the bullish, and then you saw the upside, bit of consolidation, and then a false upside break, and then down subsequently further downside. Bullish hammer didn't really work especially well, probably because then it was subsequently done over by a shooting star on the 24th of June. So, but there we go. Anyway, basically I was just showing you this because you can subsequently use analysis across a number of time frames. Okay, so S&P 500. Now this one I'm hoping you find interesting because you will see that key 1 day reversals happen a hell of a lot on the S&P 500, and they do work. Okay, sorry, another question. Do candlestick patterns work on gold? Yes, they do, and I will show you that in my next chart after the S&P 500. Can you use candlestick patterns for 5, 10, or 15 minutes? I'd say yes, you can to a certain extent, purely because, I mean, okay, what I'll do is I'll show you FTSE on, I'll change it to a 5-minute candle. The candles do work, yes they do. You will find though that on the less liquid trading stuff, trading in instruments, you will not get such good patterns because you'll get a lot of sideways movement. But yes, you can use candlestick patterns. The only thing I would say is that the more short term you do your analysis, the less likely I think it is to work, certainly using candlesticks. And I think that is purely because you do get a lot of similar candlesticks in a row, and you quite often get some sideways movements, which you wouldn't get necessarily across hourly, daily, certainly weekly trading. Okay, so S&P 500, December 2012, lovely bullish key 1 day reversal started. Saw a resumption of that uptrend. I've actually seen another one just as we're speaking, so I will add in another one which was there. So this trading pattern here, another bullish key 1 day reversal. Okay, so you then got in this big uptrend on the S&P 500. What happened? you got a bearish key window reversal at the top of that uptrend. Subsequently, big correction, bearish key window reversal. So very important pattern there. You go on, go on, go on. What do you see is period of consolidation, November to December 2013, bang, bullish key window reversal into the next week or so of strong movements to the upside. So you do get a lot of key window reversals. Okay, what are we looking at here? You've got bullish hammer, again not your strongest hammer pattern because you've got the close below the open. However, it is still you still made a new low. You then rallied back towards the high of the day, and then if you look at the next candlestick, it was a strong green candle, so you then start to think, okay, well there is something in this, and it subsequently goes to the upside. You then get a strong outside day there. Here's a bullish key window reversal that didn't work. I thought I'd show you that just for balance. But then you saw throughout March, you saw a series of pretty weak candles, and then you saw your hanging man, which is there, and subsequently done by an outside day. So you've got a series of negative candlesticks that subsequently you do see a fall away again. Bearish key window reversal, again, April 2014, new high, close below the low, subsequently the next couple of weeks of downside. Okay, now where are we at the moment? This is where I'm going to get excited, because yesterday we had a bearish key one-day reversal, a pretty big one as well on the S&P 500. Now, at the moment, we've got a slightly green candlestick pattern. Now, does that mean that we're going to negate that the bearish key one-day reversal? I don't think so yet. I certainly think you'd need a significantly more green or bullish candlestick pattern to negate that. But it certainly looks like there is the potential now for a bit of downside on the S&P 500. So watch this space, bit of a correction there. What you'd do is, ultimately, if you were going to trade it, you'd make sure that you'd be looking at other indicators to try and get a bit of confirmation, but certainly it looks pretty corrective on the chart. Okay, gold. Back at 2011, September 2012, what do we get? We got two bearish key one-day reversals at that all-time high. You got one there in August and another one in September, and I think after the second one you would have definitely be going, okay, there is something in this, because you got another bearish candle. Although you did get that recovery from the first one, you never really took out that first bearish key one-day reversal, and subsequently we saw, I mean, gold has never been back at those levels, so very interesting there on gold. What do we see? A rally in December, January 2012, bearish key one-day reversal. Subsequently, it didn't really correct that much, but certainly you're then beginning to get a bit concerned when you see a second one of this magnitude here in early March, and subsequently gold then just went down, 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 and yes, so bearish key one-day reversals on gold did work. You got another one here at the high. October 2012, we had the rally and a bearish outside day. This is, sorry, not a key one-day reversal, but a bearish outside day where you see a new high and a move to a new low below the previous low. And yes, it didn't quite close to the downside, but certainly the subsequent candles where you're seeing the momentum build to the downside again, that subsequently did see that. Okay, just very quickly, I've got a couple of charts. One chap, Colin's saying, I notice you don't use moving averages. What I'm doing at the moment is just showing you pattern analysis. When I get on to my general market analysis towards the end of this, I will bring in moving averages and we can then discuss that. So don't worry about that. Another question. Does the doji only signify the upward trend? I haven't really I haven't really looked at, or talked about too many dojis, purely because, as I said, they signify what I'll do here. There's a few down here on gold that you see. A doji candlestick pattern really just signifies uncertainty with the trend, and that's what you had here. You've got a doji candlestick there, so you had this period of sort of of bearish but then sideways trading, doji candlestick, bit of indecision, and then bang, it starts to go again to the upside. You see this doji here as well, where you open and close at the same level, sort of starts to run out of steam, you'd argue, and then back on the upside. This trading period here, this doji had this strong uptrend through August 2012. A doji candlestick pattern just denotes, as I said, uncertainty with the prevailing trend. Prevailing trend was strongly to the upside. Bit of uncertainty. It starts to then drift off again. So it's just a warning candle. I don't think it's something you can trade off, and I wouldn't be trading off it personally myself, purely because it doesn't actually show you all that much. It just says that what you've got, what you've had in the run-up to the current trading period may be coming to an end. It just gives you a warning that you need to be looking out for possible signs of a reversal, rather than saying, okay, well, I'm going to now start to go in the opposite direction to the trend, because the problem is that the trend is your friend, and as we've learned previously, and to be honest, trading against the trend unless you've got decisive signals is not a very will often tend to not be a very profitable way of trading. Okay, so back on your key reversals. Okay, so hold on one sec. Richard, what is there between 13th to 20th of August to indicate such an increase? Okay, so 13th was the 5th. Okay, so you had this strong move to the upside. Okay, well, if you zoom out, you've got a bit of a base pattern going on here, and what I would say, this is just me working off what I would view this as. You got that big old support there, although you did slightly breach it, but you'd be saying that that is an old support area. Becomes new resistance throughout this base pattern here. 3 months of a base pattern, in fact, and then subsequently you break out to the upside, and you see that move just continue to go. So what you'd be doing is you'd be saying, okay, well, we've got that breakout. You've seen that doji candle, which starts to give you a little bit of a warning that maybe the trend is not going to continue. You subsequently get a little bit of a shift backwards, and what you'd be saying is, okay, well, I've got a pretty decent band of support there between 1630 and 1640. You never really got back towards it, and then you subsequently got this bullish key one day reversal, another one. Bullish key one day reversal that starts once more the leg up to the upside. So it's you need to be just aware that a lot of the time you'll see these bullish reversals, and there'll be breakout charts because they're such strong moves, and they'll be just resuming. As you can see here, you had this period of upside, just consolidated back, and then bang, you had that bullish key reversal that just took out all this trading period here, and then you subsequently had a strong run higher, and you had a move back towards this base pattern. Would have given you a target of probably, although I've not been able to measure it, I'd say probably somewhere around that 1750 mark probably. So it's a very strong move. Okay, back on bullish reversals and candlestick patterns. Okay, so you had a bearish key reversal there that ended that strong run higher. Interesting, because you then subsequently got a big correction that you never really got out of on gold. Very, very big correction. So interesting. Okay. No real. I mean, I'm sure if I looked long enough, I could find some more signals. Until, lo and behold, you get a bearish key one day reversal on the 17th of March, which ended this strong rally that we saw January, February. Bearish key one day reversal, and you bang on once again to the downside, and we've not yet come out of it. And lo and behold, at the bottom, what have you seen again? A bullish key one day reversal on the 5th of June. They do happen a lot, and it seems to be on gold it happens a significant amount, but I think in my experience it does happen a lot on the S&P 500 and does seem to happen a lot on gold. So two charts there that I think you certainly need to be looking out for your key reversals. Euro, here we go. We're on to currencies now. Exciting stuff. Euro. Okay, so we're looking at reversals again. April 2013, bullish key one day reversal started the trend higher. Okay, so we go on, go on, go on. That's my next one. As I said, you do have a lot of, I mean, to be honest, I could have done that one there, but it wasn't actually at the low, but certainly it started off this move to the upside, so I could have had another one there. You've got a doji candlestick here. Again, I've just highlighted that because it just shows a little bit of uncertainty, and what happened, the market went sideways for a couple of weeks, so just shows that dojis can be just a signal of uncertainty. May 2014, so recently, bearish key one day reversal. Now, admittedly, yes, I suppose the argument being that that was on ECB day, and you get, yeah, I could imagine if you did the stats on ECB days, you'd probably find quite a lot of reversals or key one day reversals. But still, if you're trading it on just using technicals, there it is, big new high, massive new low, and then subsequently big sell-off. And where are we at the moment? Well, ECB day, big bullish key one day reversal, and we haven't yet seen the low. $1.3502. You haven't seen that broken yet, so you'd still say that you're in a potentially even a bullish key one day reversal phase. Although, I mean, yes, I've shown you this outside day there, which is another positive pattern. My theory is still I don't see euro going too much further. I see a massive band of resistance that comes in around that 136.70 mark that I think is going to just hold back any sort of advance on the euro, and I think this is a nice little opportunity to sell, but we'll talk about that a little bit later. Okay, so that's euro. Sterling, what are we looking at here? September 2012, shooting star. That's an outside day. So you're getting a series of patterns which suggest that the bulls are running out of control of this chart, and subsequently you had this big run higher and then subsequent correction. So you need to be looking out for these. Again, into November to December 2012, shooting star, two big shooting stars there, and then subsequently the big red candle that follows them. So you then start to think, as I said again, the confirmation thing. So we're looking at that. We're on. You could argue, I say argue, that is a hammer on this on the 12th of March 2013. But you didn't really. Would you have gone after it? Maybe on this trading day here, where you get this big green candle. So maybe. We're going on. As I said throughout this, I'm not talking about every single pattern. I mean, for example, I've just seen a shooting star there, which ended this long run higher, and subsequently you saw a correction. So I'm not talking about that. Not talking about every single pattern, and I'm sure you could probably all pick me up on loads of things that I've missed out. But I'm just giving you a bit of a gauge of things to watch out for. Certainly the key moves I think are the bullish reversal, the bullish key one day reversals, the bearish key one day reversals, and what are we getting here? Cable, bearish key one day reversal, correction, ended by a bullish key one day reversal, rally, ended by a bearish key one day reversal, correction. So you see, this is all January. So you get these trading periods. So you do get a lot of key reversals that signal a correction or a rally in the market. Okay, so I've got another question. I'm assuming. I'm used to assuming that the shooting star signifies that the trend is about to go for a reversal. What do you think? Well, yes, as I said, I mean, you get hammers and shooting stars. Hammers tend to be, as I said, on our... This is back on the theory. Hammers can come at the bottom and tend to be the reversal of a bearish trend. Shooting stars, on the other hand, tend to be at the top of an uptrend and signal a reversal as well. So yes, you are indeed correct. Where are we? We're on sterling. So yes, you are indeed correct. They do happen as a trend reversal. Okay, so cable. So back towards anything since then? No, not really. But as I said, I will do a bit more of an analysis on cable in a bit. Okay, so Japanese yen. Again, this is only this year, and look at the number of patterns we've got throughout this year. Bearish key one day reversal, right at the top, 105.44, right at the top, signaled the top. What do you get now? Bearish key reversal, sort of a continuation of that trend really. It's more of an outside day, you probably call it, than a bearish key reversal, but still you've got another outside day there. It's just shows the continuation of that trend to the downside. Within this move, you then start to bottom out. Bit of I've circled it because it is arguably a bit of a hammer candlestick pattern, but it didn't really work out all that well. And there, what have we got here? Bearish key one day reversal. So that was in April at the high, 104.12, and then you've just got a series of candlesticks that you could trade off. You've got a doji there, followed by a bit of a hanging man. So you'd start to think about whether this sort of 2-week trend here is beginning to run out of steam, and it does, to be honest, because you then sort of trade sideways, a little bit lower. A rejection of an upside break, so a false upside break, and what you would argue being a shooting star. So you've got a series of bearish candlesticks here that subsequently you then start to shift to the downside. Forming support, you then get a hammer, arguably because it's slightly closing below the open. But then you get a doji, and then you get a sharp green candle, which arguably suggested that you're going to start to push higher. But since then, you've pretty much gone sideways, and that's where we're at on dollar yen. Okay, I'm gonna finish off this with the DAX, because this is DAX on a daily chart. You've had a bearish key one day reversal. Just got to be careful on the DAX, I think, because I mean, you look on this chart, and there's just gap after gap after gap after gap, and it doesn't. It just leaves me a little bit concerned as to how to play the DAX because of the enormous amounts of gaps that you get on the DAX. So you've got to be careful of that for a start, and you do tend to, for some reason, I do not know why, but you do tend to get a lot of seemingly false signals on the DAX, which can do you over a little bit. But certainly at the moment you have got a bearish key one day reversal, which is a fairly dominant candlestick pattern on the DAX, but I'm not going to focus too much on the DAX purely because of that. Right. Okay. I have tried to get through your questions, but what we'll do now is a quick live analysis of what we're looking at. I'm going to start with euro dollar. I'm going to bring in, as I promised earlier, all the moving averages. I've brought in momentum indicators as well, so please excuse me if you get a little bit lost at this period, but we have, to all intents and purposes, finished the pattern analysis, single trading pattern piece of the webinar, and this is just going to be a bit more live analysis for you, for those who are interested. So thank you very much anyway. Right, so yes, where are we looking at on euro? Well, I've got drawn in here this resistance that is now turned into support, so that's 135.85. Zoom in slightly here. 135.85, so that sort of now has become the floor, but euro only today has really started to make any sort of real headway, and that real headway has come on the back of this GDP number that we've had in the last couple of hours, that's come out and disappointed so enormously for the States, and also the durable goods numbers as well. So two very weak bits of economic data. Certainly the durable goods data, I think, is also concerning, because that is data for May, whereas GDP for the for Q1 is obviously Q1. But anyway, that's put euro, or certainly dollar, sorry, on the back foot, and the euro is trading higher and is beginning to now edge back towards this key resistance at 36.70 that I've been looking at for a long while. As I said earlier, 36.70 is this neckline of this big double top pattern. Again, double top is a pattern that I will be talking about next week in next week's webinar. Sorry, next week, 2 weeks time, and that is the big resistance now in place. So that is not too far away, 36.40. So it's only 35 pips away to the upside. In terms of RSI, though, you would actually say the RSI is actually more encouraging than it has been for the last 6 weeks. So whether that's something to go on, interesting. And MACD lines not all that bullish, and stochastics as well. I just still think they're unwinding this oversold bearish scenario, and I think it's just going to be another chance to sell on the euro, because that's basically how I'm looking at euro. I think this big top pattern is the overriding pattern on this chart. If you zoom out as well, you'll see that this 144-day moving average is the base of support. Sorry, had been the base of support throughout this move higher, all the way up, and is now, I think, going to become the base of resistance. That's at $1.3712 at the moment. So yeah, that's my view on euro dollar. Okay, so going to look at cable. Cable's an interesting one because you've had a fairly disappointing move yesterday that started to see cable unwind, but you've got this big support now at 69.20, which was the old resistance that has now become not once but twice the level of support. So that is didn't quite make it down to there today, 69.49, and that drift off, that initial move to the downside today was on the back of that again, that 130. Sorry, was on at the back of Mark Carney's announcement yesterday that he sort of flip-flopped around on monetary policy, but it certainly looks as though he's not necessarily as hawkish as some had latterly been expecting. But then the rally that we've seen has become on that durable goods data and GDP data. So it looks like 69.20 is the big level that we all need to be looking out for on cable. So just bear that in mind. I've just noticed as well that you, as I said when we looked at trend analysis, you need to keep all your trend lines on the chart because they can do a job in future even though they've been broken. And this is the old primary uptrend, and it looks to still be doing a job. So we had it being used as a base of resistance, now breaking back above it. It could now become the base of support again. So I'm going to still keep that on the chart. It wouldn't be my primary basis of analysis, but I think it's still something to bear in mind. So what are we looking at on cable? I think cable is, as I said, coming back to the 69.20 mark, and I think that that will be a key turning point in cable. If that support can hold, then we're going to stay bullish on cable. If that starts to break down again, I think then we've got to start to think about possibly another serious test of that uptrend and bull run on cable. So I think 69.20 is the key mark, and at the moment it's finding support above that. So you have to remain on the bullish side and to buy into dips because of it. Okay, Japanese yen. It's just absolutely dour on dollar yen. I find this struggling to really pluck up any sort of positivity to talk about it because it's so boring. It's gone sideways for the past 2 weeks. Moving averages sideways, momentum indicators almost entirely neutral. Although today you've had a slight shift back down to the negative, and 101.60 is being tested. 101.57, that is the key support, obviously near term. We need to hold on to that if the dollar is to remain any sort of bullish outlook, but at the moment it's certainly neutral to slightly yen positive, which would be dollar yen negative at the moment. So you'd be just on that slight tack. I still think 102 pivot, 102 big figure is a big pivot level, and any move towards 102 you could argue is a selling opportunity, but certainly I'm clutching at straws a bit here still, so it's basically still going sideways. Not a great deal going on there. Gold. Last 4 days it's gone sideways. You've had almost a doji candlestick there, and pretty much not too much else to go on. The rally on gold today happened again after that GDP data, so pretty much across the board dollar negative that we've seen. So that has happened, but you've got this massive on gold, this huge downtrend resistance that comes in at around 13. I think it's 13.27 at the moment. And that is certainly holding back this rally at the moment. You've got a big resistance at 13.30, 13.31, which was the April high. Much beyond that, you've got the RSI, which is overstretched. Not too bad on the MACD and the stochastics. No real signal for negativity yet on the stochastics, but certainly you'd be a bit wary of going too long on gold at the moment because of this big primary downtrend that we've got, and also that April rally high at 13.31. So be careful on that. Okay, so very quickly, S&P 500 is yeah, you've got, as I said, you've got this bearish reversal. This moving average here, 21 days, not really. I was going to say, is it a base of support? Not really. I suppose you'd probably be looking back at the 55, which is this red one. It certainly seems to be more of an interesting moving average for S&P 500. And that's at 1899, so pretty much 1900. But you've had this strong move higher, not really any real corrective pressure brought on yet. Certainly you found support around this little mini consolidation area here, and this bearish key reversal came after this doji pattern actually. So there's your doji, a bit of a warning, and subsequently big bearish key reversal. So the reaction so far has been reasonably positive on the S&P 500. Up, what is it up today? 2 points. So not too much, but I mean 0.2%. 3 points, sorry. But yeah, so I think I'd be waiting to see, because obviously the S&P 500 is in this big bull phase. Momentum indicators all bullish. It's just that I think this bearish key reversal could now be the first signal that you get where the bulls are a little bit worried about it. I mean, you had this one back in April that subsequently saw you back down, was it 40 points? So you could certainly see the S&P 500 unwinding back to 1920. There's no real reason why that couldn't happen. And as I said, you've got that 21-day moving average, sorry, the 55-day moving average comes in at 1900, 1900 being a big breakout resistance as well. So I think there is certainly scope for a bit of a correction. Doesn't have to be too much, like 30, 40 points perhaps, but certainly there is scope for that on the S&P 500. Okay, so DAX, GDAX I. What are we looking at? Well, we've had a series of pretty negative candlesticks, no real move across the day, lots of almost dojis and dojis, so uncertainty with the trading day, bearish key reversal, big negative candle, and really the last few days have been fairly negative. So it's possible that the DAX is sort of gearing up for a bit of a test of that 9,810 mark. And if you, as I said earlier, if you get the S&P 500 to start correcting, I think the DAX would certainly be under pressure as well, and that 9,800 mark could easily come under pressure. The primary uptrend on the DAX comes in 9,520, which is not a million miles away from that 144-day moving average. So interesting. So you could certainly have again scope for a correction on the DAX, and if you were to break 9,810, you would actually complete a double top pattern as well, which would suggest you're probably back at this old probably back towards this sort of old level around 9,600. So just bear that in mind. But just as I said, these indices are giving a few negative signals, and we'll wait to see how that pans out, but just keep that in the back of your mind. Now, the most bearish one of them all, I say most bearish, the least bullish, FTSE. Yeah, you have actually recovered in the last few minutes. Interesting. That's in the last hour or so. But you had this big double top pattern that you never really aborted, even though you had this rally to the upside. And that double top gives us an implied target of 6,682. And you would say between probably 6,675 to 6,700, 25 points there. You've got multiple support levels, and that would suggest that increasing importance of those levels, but also if they break down, then you're certainly looking in a quite significant correction phase potentially. You've got the primary uptrend. I'll zoom out very quickly. It's not a brilliant primary uptrend, but it is a primary uptrend nonetheless. On FTSE, primary uptrend, that comes in 6,700. You got the, well, I mean, I've got 144 here, but a lot of people use 200. But to be honest, 200 day even on FTSE doesn't really help you a great deal, because all these dips were well below the 200-day moving average. So it does not appear as though that gives us too much of an indication, but still 200-day moving average is at 6675. Downside target of that top pattern is at 6682. 144 at 6,700. So a lot of indicators there, and just for good measure, you've got this pivot level, which at 6,700 as well, which time and time again, 6,700 has acted as a level of resistance and then support. So 6,700, it seems to be a fairly popular level on FTSE. Okay, so I think that's pretty much it to cover today. And with that in mind, make sure, again, I sort of do say this every week, but try and make sure that you do get a chance to look at the material that we send out, the PDFs, before you do the before you come on this webinar, because it does give you certainly a guiding hand, and this one, and especially the next one as well, would certainly be very helpful for the multiple period charting patterns, which is on the 10th of July. In the meantime, if you want to follow my analysis, which I do look at and post on Twitter a lot, my handle is @HantecRich. And again, if I've not covered any questions, I did get quite a few questions today, which thank you very much, which was encouraging. And if I haven't covered any of the topics that I should have done, then please feel free to contact marketing@hantecfx.com. Where we will get back to you with further details. But with that in mind, I think I will leave you with the disclaimer once again, and for your perusal, because I've done live analysis, it's good to read these risk warnings. And with that in mind, I will wish you good luck with your trading this week, and obviously every week. And I will speak to you again in 2 weeks' time. Thank you very much for listening, and goodbye.